When I say the words roaring 20s, visions of Flappers, the Charleston, and Great Gatsby probably come to mind. Fast forward a century because I'm talking about the 2020s. The question is, could we see an economic boom this decade like in the 1920s? We're going to discuss that right now here on UBS Trending. Hello, everyone. I'm Anthony Pastore. Thank you for joining us. This is UBS Trending, and I'm sitting down with Jason Draho from the Chief Investment Office to talk about the quote-unquote roaring 20s. Jason, good to see you. I love the report, and as I said, we think about Great Gatsby and martinis and, all these lovely 20s references, but you're talking about the 2020s. But it's interesting because since the summer, there's been talk of this kind of new macro regime in the U.S., especially in the U.S. economy. And you had suggested this roaring 20s scenario as a possibility. What do you mean by a new macro regime, however?
So there's a lot of things that you can kind of go into it, but to make it sort of simple, the way I think of a macroeconomic regime is defined by three main characteristics. One is growth, like GDP growth. How's the fastest the economy growing? What is your inflation level? How much are prices rising? And then what's the interest rates? Both like, in a 10-year treasury yield, but also like the Fed funds policy rate. I think those are like, if you think of a three-legged stool, those are the three kind of legs of the stool, the foundation for the whole macro regime. Now you can get into more specific details and aspects, but that's the essential aspect. And it matters because ultimately financial markets really trade based on that kind of macroeconomic regime.
Right, and I remember even talking maybe with you and other colleagues when the vaccines were first rolled out after the first COVID lockdowns. Everybody felt like, wow, this is going to be a huge roaring 20s economic boom. And then, of course, we saw inflation rising and the Fed was continuing to raise rates. So maybe it stalled a little bit. So why are we even asking the question right now about the U.S. economy perhaps having this roaring 20s after what we've experienced for the last year and a half or so?
You're right that it was in March of 21, when there was sort of talk, could there be a roaring 20s?
That's right.
The economy was opening up, vaccinations were widespread, there's massive fiscal stimulus, the economy was kind of roaring back to life. That lasted a few months, and then inflation started to rise quickly. And then instead of roaring 20s, people worried about 1970-style stagflation. And that was the story for almost like kind of 2 years. But as I think why this sort of the narrative started to change in the summer is that that's when investors started to think we could really get a soft landing. Inflation's coming down, growth is holding up, and we can actually do fine. Then you further kind of move forward into the fourth quarter. You look at the data we've gotten for the third quarter. The revision for third quarter GDP, 5.2%. Like this is a very strong quarter at a time when people thought we were going to be in a recession. Then you look at interest rates. The 10-year treasury yield touched briefly 5%, the highest level since 2007. In fact, across the entire treasury curve, rates that we haven't seen in over 15 years. Inflation is still elevated, but coming down to a different level, a lower level. So if you just think of kind of the growth levels, what we've seen in the past 3 years, we haven't seen really since prior to the financial crisis. So it's looking like we're almost going back to something we haven't seen in more than 15 years, into like a definitely different regime than what we've experienced for the past decade plus.
Right, and something else that you talked about in your report was a lot of this roaring 20s rhetoric and the possibility of it happening has more to do with developments on supply side. What do you mean by that, and how much of that really weighs into what we could potentially see over the next 7 years?
So think about what happened during the pandemic, and from an economic perspective, a big dominant theme was these supply chain problems,
right.
Like the lack of supply for goods, but also we had sort of energy supply shocks in Europe when, after the Ukraine war broke out. So it's definitely already been a decade dominated by supply stories, but it's also been a story where there's massive policy stimulus, so very strong demand. These are very different than what happened in the 2010s, coming out the great financial crisis in 2008. Demand was constrained because there was just so much of a debt overhang. Supply was fine. This decade, it's been very different, very strong demand. Supply has been constrained. Now, the supply problems are easing, but I think that kind of basic framework, thinking about like supply and demand at a very macroeconomic level, is a way to help kind of contextualize and think about what could go forward. So the key point we make in the presentation is that this decade we think will be dominated really by supply factors. It already has. There could be challenges when people think about things like deglobalization, security as being sort of like a negative supply story. But there's also positive supply stories like artificial intelligence. That's a mega trend we talk about in the report. That's ultimately a positive supply shock. You give people this technology, it makes them more productive. You can grow the economy faster at lower inflation. The green energy transition. How do you supply energy? That's going to change sort of supply curves. A CapEx boom. There's lack of labor, shortage of labor supply. companies have to rely on technology capital to substitute for the labor. We think those things could really sort of dominate the story, and that's really what's going to matter for this decade, is that whole supply side.
So in your assessment then, do you think that we are on track for, I mean, obviously there are lots of other developments that could potentially take place over the next years to get through this decade, but generally speaking, is it a roaring 20s that's ahead of us?
So I think we'd still say conditions are in place for this to materialize, but it's still sort of a bull case scenario. Like it's an upside, because things have to go right in terms of positive supply developments. The CapEx story really plays out, leads to productivity growth, because really the key aspect of all this is, can we make the economy more productive? Because if you're more productive, then you can grow faster and grow higher without having the same inflation. The parallel that I use, and we talk about roaring 20s, it's really almost like a replay of the 1990s. In the second half of the 1990s, that's when the internet sort of dot-com era really took hold. It was an era where productivity surged. You had fast growth, you had falling inflation throughout the decade, a really good decade, which wasn't apparent back in 1994, but that's sort of something similar, like could AI be sort of,
Right.
the sort of the same sort of story with other factors playing out. The challenge is that there are geopolitical matters, there are policy matters, there are debt overhang issues. There's a lot of things that could go wrong, and we don't know when these supply side developments, like AI, for example, it's going to have an impact. Will it happen in the next 5 years, 10 years, and how large will it be? So huge variation, but again, if things kind of work out well, it's a very plausible scenario. It's one that we think is, rising in probability, certainly relative to 2 years ago, but it's also probably more than I think most investors think, because they tend to focus on all the negatives and not realize there is this upside scenario and people aren't appreciating it. I think now, though, like they're kind of recognizing this could be a different environment.
Yeah, but and it's interesting because you look at sort of the dichotomy of maybe what the expectations are, because we, obviously there's a lot that could potentially help us have that roaring 20 scenario that we're talking about, but at the same side, if you look at the other side of it, still people are concerned about recession. Some of our, research that we see from other firms and other strategists says that might be the case. We even here at CIO expect a bit of an economic slowdown. How do you reconcile those two things?
So when I described earlier, like a regime, the way we think of it is growth, inflation, and rates. But a regime means something that's more structurally in the economy. This is a multi-year thing. I think a nice analogy to think of it is the difference between climate and weather. Climate, and we talk about climate change, climate is like, what are the overall conditions that lead to your temperatures, your wind flow, all those kind of things. But you can have climate change, that doesn't mean that you don't have the seasons. It's still getting cold in New York, even if there is climate change.
Sure.
We get spring, summer, winter, fall. The same thing in terms of a macroeconomic perspective. What we're seeing is that kind of growth over time could be higher, sort of the trend growth goes higher, but you still can get oscillations around it. So it's not inconsistent to say we think growth in 2024 will be less than it was in 2023, but there's still a macro environment the rest of this decade that will be higher. Again, going back to the 1990s, the Fed raised rates a lot in 1994, things slowed down in 95, and then they took off in 96 to 2000. Something similar can happen this time. We get the slowdown in 2024. That sets up for faster growth in 25 and beyond.
Right. So if you think about it from the investment perspective now, we look at equities specifically, and certainly there's been a strong S&P 500, strong gains in the S&P 500 this year, but with an asterisk, which is, the top 7 names in there, which are technology-led, certainly lifted most of the other boats in the index. Does this roaring 20 scenario bode well for stocks? Could we still see that type of growth? Are we going to start to level out? What's your expectation?
So when I speak of roaring 20s, I'm talking specifically about the economy and how the macro environment can look. Just because you've got to have a roaring 20s economic type of environment doesn't mean you would have a roaring 20s stock market. Which, when I kind of brain up this idea, people think of like, didn't we end with 1929 with the stock market bubble market crash?
Right.
Even in the 1990s, okay, great, but we had a stock market bubble that kind of crashed in 2000. It doesn't have to happen that we're going to get a stock market kind of roaring 20s scenario, partly because valuations are already quite elevated. If we take today where the multiple is for the S&P around 19 as a forward basis, this is much higher than it was back in 1995 when it really kind of took off. We kind of ended up higher but started much lower. There's also the question of like, if this scenario plays out and an AI is a key driver, how are the winners? Is it those same 7 stocks and everyone else doesn't win? Or is it much more diffuse? So I think it's, just because the economic environment can be good doesn't necessarily mean that it's going to be a boom for the stock market. It certainly helps. It's a positive in the column, but it's not kind of a guarantee. What we can also say is the macroeconomic regime is going to be different this decade than last decade. Some of the rules and the way you think about portfolio construction, diversification, what goes in a portfolio, those definitely are going to change in ways I think we have to think differently at a minimum. How it means though for equities, I think that's still be determined, even if the scenario plays out.
Great, Jason, thank you so much. Good conversation. Great talking to you about this, and there's exciting things coming down the pike, so we'll have lots to talk about over the next 7 years or so.
There's a long runway for
discussion.
discussion.
That's right. Thanks, Jason, appreciate it. And there's a lot more information for all of you on our Insights website at ubs.com/views. You can check out all the other CIO content, including our recently released Year Ahead publication. So take a look at that. Also, you can check us out on social media. We're on all the channels, including Instagram at UBS Trending is our dedicated UBS Studios channel. So make sure to follow us and look for content there. And as always, if you have any questions about your portfolio, make sure you're talking to a financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.